Hello, ladies and gentlemen, and welcome back to a special edition of our show where we discuss the markets and key levels right now throughout them. Of course, we are leaning into one of the most important announcements, the FOMC statement on Wednesday this week in America. But this also brings us to a point of critical resistance and critical decision making between the bulls and the bears. We know Wall Street continues to pile in with huge amounts of shorts. Retail traders have also joined them on the short date. But at the same time, the market just continuously, relentlessly goes up. So what's really going on underneath the hood? Well, in today's video, we'll be explaining all of the key psychological factors that really make the market tick. Stay tuned, guys. This will be a good one. So welcome back, everyone, to the show where we talk about markets around the world daily. If you like anything to do with markets, then of course subscribe and smash the like button if you find value in today's video. Let's begin by discussing smart money versus dumb money confidence. As you can see, dumb money kind of continues to rise in confidence while smart money has lessened. Now, you'll notice they're kind of opposite to each other. Smart money tends to pile in on the dips, and dumb money tends to buy kind of the rallies. And that's what's happening here. Now, we've seen readings similar to this over here. And we obviously had a reading that was pretty close to it over here before the crash back in April. And what it leads into is sideways and then sometimes a down market after that. It's a good indicator and it does help us out to understand the human psychology underneath the market conditions. What about small traders though? Of course, options is a huge part of the market. We've got some great stuff later on today's video that cannot be missed about what's happening ahead of the FOMC and after the FOMC statement this week. But here's the small trader options opens, and you'll notice that they keep piling in. It's like us, we keep piling in to short dated puts. That is really the small traders continuing to buy puts at a pretty fast rate. Now, if we go back and look at something like this over time, you can notice that while there has been dips or at least sideways kind of markets and small dips, it usually has led, this particular indicator has led into further rallies. So we need to be careful here. If we do get a dip, let's say in the next couple of weeks, well, unfortunately, so many people are bearish. Markets like to do the opposite to that. But you know what? Even the biggest guys are bearish, that you'll find out soon. S&P 500 sector valuation dashboard. This is just a great chart to have. Always look at the data and look at the valuations compared to history and stuff to try to figure out whether it's a good point for you to invest. Now, a lot of people have missed out. They're feeling FOMO right now. You know, I think we get that. Like, it's tough. These markets are tough. You've got to have a plan if you're investing. That is, some people use dollar cost averaging. Some people just say, okay, these are the key levels that I'm just going to literally buy, and they stick to their plan. A lot of that can be brought down to, of course, averages over time. Here we have 10-year peaks, 10-year average, and the current PE. So you'll notice that based on the 10-year average, some stocks are just moving above those. Some stocks are still underneath them. Over here, telecom is cheaper. Some are cheaper, some are more expensive. It's good to have this so you can really figure out whether a market is cheap or not. Now, one of the reasons that most people are buying into this market is people have predicted that inflation has peaked. Look, I hope that's true, and I hope that we don't have some kind of sticky inflation where certain things like rent rises, etc., become a problem. We go into stagflation. I don't really want that. Neither should most of you. Some of you say you might want it. If you do, then you probably like gold. That's one of the only thing that does well over those periods of time. But here's the expectations coming into 2023. And obviously the market is really projecting, and this is the economists, they're projecting a soft landing, kind of a Goldilocks situation. Now, they're predicting that, but at the same time, the bigger hedge funds continue to short at an outstanding pace. They're really shorting. Now, I want to bring this chart up because what you'll notice is that they do often get it kind of wrong. Like over here in 2020, the big hedge fund managers tried to heavily short the market. They then had to instantly reduce those positions, which happened during the dip over here. This, if we do dip, which is probably inevitable at some point on the stock market, is what we have to watch. If they reduce their shorts at an outstanding rate because they got caught, e.g. like a Barry or something got caught, or whoever else is shorting this market right now, if they reduce similar to 2020, I think you have to take that as a really big sign that yes, the market is about to turn and continue to go up. It's a big deal. If they continue to stack on the way down, or they don't reduce their shorts, this is something we have to watch in the coming months. Remember, September and October and even the back end of August are often weak in markets. What an important chart. We do not want to be caught at this point, not really seeing what those guys are doing. So is everything peachy and happy in the world? Well, of course, you could throw probably 50 reasons why the market should go down. And here's one that's very interesting. And this is China's unemployment rate. So no wonder they're having to stimulate their economy. Take a look at this. In the urban areas, it's almost 20%. Wow, that is sick. That's pretty bad, guys. So that's a big one. And of course, why has this happened? Well, it's lockdowns and no real support for small businesses in China. They're hurting. Deglobalization is here. That's obviously leading to part of the inflation factor as well as Western economies try to bring manufacturing back home, etc. But take a look at this chart as well. I'm not paying attention to this. This is basically the increased active cases and cases coming out in China of COVID. Now, we know they locked down. Of course, they locked down something like Shanghai, Beijing, Shenzhen, one of these main kind of areas of production. It's going to hurt supply chains. The market won't like that. So watch this number as it has risen in recent weeks. And that's similar to what we saw over here in the March point, which obviously kind of was a catalyst for this market to turn and go to the downside. So what about for investors? Let's just quickly talk about investors. I do like to cover both traders and investors. Well, investors should be pretty happy with the current market. Of course, you have breadth, which looks pretty good on the surface. You also have corporate insiders. This is the true smart money buying at a rate that we've seen in the past that has led on to significant gains. And remember, based on stats alone, they're not wrong. Over a long period, even 3 months here on this particular reading, they've been up 100% of the time. And these aren't small stats. 1 year later was massive, okay? So you shouldn't necessarily feel FOMO towards anything, always come from the abundance mindset. It's interesting to see insiders purchasing because these readings, as an investor, are hard to deny. Now, from a trader's perspective, what are you interested in? Probably volatility. Good news, volatility based on stats is set to rise. Again, midterm elections, no one's talking about it. We know the stats are there. We also know that we're at a pivotal time here. If we don't really turn in the next 20 to 30 points, maybe that fast on the S&P, or at least get a nice turn, then we could be in one of those really crazy markets where it keeps rallying. These are the two case scenarios based on previous history of 100 years. And what you'll notice is you have, of course, your big decline kind of level where you go back down and test the lows. That's certainly a case that can still happen. And we have that increase. It's what happens probably at the point we'll look at in the chart soon in today's video that becomes the most important factor to follow along with that chart. Of course, S&P 500 seasonality based on midterm years. We know September and August, by the end of them, tend to be really weak. I've got a video coming later on talking about 200 plus years of stock market data and what happens during September. So make sure to subscribe for that one. But again, we can't deny the back end of the year tends to be quite strong. Earnings season's still on. It's trash, really. I mean, 61% beat rate's pretty bad. That's one of the worst readings I've seen for quite some time. It's, again, not a fundamentally driven market here. It's driven purely by the Fed probably pulling back. So for the bears, what are you looking at right now? Well, you're looking at a market getting very close to a critical point. We've discussed this point for a while. The trend is still up, so bears shouldn't be activating without options. And of course, that's what retail traders are doing. I'm not sure how many people are actually short, but basically we have here a very interesting phenomenon. The previous 24 hours of trade, we saw staples, utilities, and healthcare in the top kind of 5 and 6 sectors. Now, these are defensive. If we see this run again in the next session, it's kind of like showing us Wall Street is positioning in. Remember, guys, Wall Street can't just go instantly cash on their funds. They instead hide in defensive positions. Utilities, staples, healthcare tend to be some of the better performers in downward markets, or at least they stay firm. Lots of earnings coming up. If you're interested, check out that chart. No really huge ones that should completely modify the market. Not like when you have the Apples, the Amazons, etc. So let's get into the charts. Let's begin by talking about here the VIX. The VIX is at 20 ahead of the FOMC statement. We've seen this happen a few times before. We won't stick on that chart, but obviously if you're feeling the volatility, this is the point where it should begin. Another thing that we've seen going on right now is bonds, and We will have a special later on this week in the videos talking about bonds and their correlation to the stock market. It's going to be a great video. Make sure to sub for that one. But TLT here, still showing the inverse head and shoulders. Obviously, if you believe we're out of the worst and the economy's, let's say, still going to go into recession, you think that US 10-year is going to go down, TLT is the main play here. A lot of bonds traders do like this one. I don't blame them. And of course, it's really accumulating at a pretty nice rate down here. It's kind of like one of those things where it's a hedge against certain things. And the big thing about it is that also, even the decline to where it is from the December reading last year is still 25%. So for one time, if bonds were to turn, they've actually got more upside in them in some ways than the stocks themselves. Notice that big bonds are not coming with this stock market right now. It's why we will talk about bonds in the next session. So we'll certainly have that in the next video. What about the US dollar? Well, the US dollar continues to rise. We discussed the idea that we thought the US dollar was bullish. It's now reached a key zone. So this area here was probably a bunch of shorters in the market. You'll notice here we've got the 200 moving average as well, sitting here on the 4 hour. It's come and hit that. It probably does want to breathe up, but if it breaks past this high, it could go easily into the 107 kind of 50 range. Further pushing the US dollar up should mean that maybe some people are fleeing the stock market at the moment and they're moving into, let's say, defensive positions such as cash. If you go really small time frame and we jump into the smallest of small charts, you'll notice that it did have a little turn here. We basically made a small peak. Then we've come back down. I'd expect it to kind of rally to 106.55 throughout the next parts of the sessions and potentially find some weakness there. So be careful here. If you're going long DXY, you probably want to see a break of this high and then pull the pullbacks into the real kind of move. Now that's led to gold also declining, which happened exactly where we've been discussing it. Obviously, we are bullish on the medium term here for gold. August, September, some great months for precious metals. I would love to see gold back down to the 1755. I'm sure a few of you would. Let's have a look under the hood here. Let's go to the 1 hour chart and just discuss what's going on with gold. So if DXY continues to strengthen, that is the US dollar, then we should hopefully see this enact continue resistance. So of course we have support, could have that as resistance. We turn, and ideally if we get a new low here, let's say we do snap that low on gold, 1773, most likely we then return back down to 1754-ish, the defended area. And this area here, I believe there's buyers here. I mean, there was before. This is a critical zone, certainly one to have on your charts, just like an alert should we break past something like the 1808 area. These two zones on gold, I really like gold at the moment. I think it's one of the better trades in the market. At this stage, I'd be probably a little bit bearish on it based on its current price action. I'd be more bullish on it down here based on technicals, and of course a break above here, really bullish on gold. So keep watching that. We know money flow made a huge switch a few weeks ago to go bullish. Now what they do is they usually rotate the market back down to allow them to get more positions to potentially push up. And everyone was so bearish on gold. They've just made that switch. What about going on with US oil? Well, oil got really hit bad. It fell off from that 94.75 level all the way down, made a new low, kind of swung that low, and now it's rallying. If you're bullish oil, I probably wouldn't be bullish on it until it breaks past 95. So 95, a little bit of a pullback, rally up. That would probably be the trade there. You know I'm bearish on oil over the next 6 to 12 months. That's my personal opinion. I think oil's going lower. But right now, if you were looking at this chart with the swing, with what's going on, above 95 should bring the bulls in. Otherwise, the bears are kind of floating around in this current price. My long-term goals are down here, but that's not for a trader. That's a way longer kind of position. Let's move over to the US 2-year. What's going on there? 3.176. So it hasn't really dropped that much. People were making a big deal about this in our live stream. They're like, Tom, I see it. The yield, guys, the yield's going down. Yes, it is, but it hasn't fallen that much. Probably the FOMC statement will really, really change this. Obviously, a spike above, let's say we go past 3.4, watch the stock market feel that pain. If it drops back down, gets underneath 2.8, you've got to pay attention to pullbacks at that point because it's kind of pointing towards maybe that any pullback will be met by huge amounts of buy demand. Incredibly important chart to be watching along with the US 10-year this week. Watch both of them, guys. That's a big deal. Tesla, what happened? Well, we filled the gap, so that was pretty nice. We hit the resistance. Now, I know a few people in our room are talking about this one, and I thought I'd bring it up. So the idea is that basically you currently have a coiling market within Tesla. Obviously, if we break a new high past 960, people are going to go bullish for good reason, trying to attack the 1050 zone. So they're going to go for that trend line down. Now, we've discussed this for a while. Further bullish action could push us into what is a really great trend line. Now, I don't use trend lines too often because they're very subjective. We'll look at Apple in just a few moments to prove that point. But this is an interesting point here. Now, we know there's probably orders sitting behind here. So watch very closely how the market reacts if it does go bullish around this 960 area. If it comes up, hits it, and then instantly rejects, you've got to pay attention, guys. So for Tesla, if it goes past and closes, it's kind of pointing towards the 1050. So be very careful around that 960. It's at resistance ahead of what is pretty much everything at resistance. Apple is tough. There's no doubt. This thing is a locomotion machine. It's unstoppable. If you ever wanted to find probably one of the best bull instruments in the markets when things turn around, it seems to be Apple. I mean, it's just unstoppable for years and years and years. When the market has started picking back up, Apple has outstripped all other market kind of stocks really in the big caps. It just does so well on the recovery. Obviously over 30%. It's now gotten up to, a trend line here that we were discussing. Now, this is where you can get into a bit of trouble. You could draw the trend line like we have here. You could draw the trend line through the highs, and then you could say, well, it hasn't hit it yet. So if you draw the wick, you would draw like that and say, well, it hasn't quite hit it. That's the problem. It's why I do prefer horizontal. You can make mistakes with trend lines. Just remember these things. And I don't know actually what to make of this chart. It's super rallying, super gappy. And look, I always come from like the patience abundance mindset. I'm not going to freak out here. I know that whenever you get these kind of moves, you generally get nice pullbacks later on. It's just whether you can handle it. If you're in it long term, well, you're not going to sell, are you? You're just going to be sitting there saying, well, this is pretty sweet. Look at me, my Apple. Unless you are, of course, trading it. So from a trader's perspective, I think the risk reward becomes less up here. We've discussed that. From an investor's perspective, it's a totally different one. You need to pay attention to this. Let's have a look at consumer discretionary versus staples. Still holding pretty well. This shows us risk on, risk off in the market. All of 2022 so far has been horror show. It helped us very much prove and provide the bottom kind of concept over here in July. We've seen that really rallying through. So this is consumer discretionary versus staples. If we see this turn down, what's that telling us? A further move into staples, and that's a defensive move by the market. Let's watch this next 24 hours, see what happens on this indicator. We'll bring it back. What about the DAX? DAX is literally going into a pretty undisputed trend line, big level. This is very easy for everyone to draw. Huge zone, 14,000, critical psychological zone. Move over to IWM. It's having a nice little ramp. Small cap still down quite a lot. Like if you take the high over here, and you work that high down to this level, it's still down 17.69%. Obviously, big recovery here in the small caps from the bottom to the top. Load X IWM versus SPY, which we've done a few times, and you'll show, in fact, I'll do it for you guys right now. So if you load IWM versus SPY, you'll notice we're at point critical ahead of the FOMC statement. This is where it all changed in the market during 2020. And really, it could change now. That's where we saw that huge outperformance of the Russell, the full breadth recovery. Will we get that again? We're at that critical zone. You can see it, guys, here on the ratio. Big deal. Ratio up stuff. It's a big game changer in investing and trading concepts. Let's move over to the Dow. Again, trend line. Bang, bang, bang. Key resistance. Where are we? Ahead of the FOMC. Big level here, guys. Move over to the Nasdaq. What about that? 61.8 fib hit, obviously, through the trend line. The Nasdaq has looked better than the other markets, but we're at a 61.8, the golden fib level ahead of the news. Let's move over to the S&P 500. Where are we? Well, here's where things get interesting. We have a 200 SMA. We have a downward trend line. We have a previous high. We've filled the gap in the last 24 hours. We've got a Gann number here, or Gann number. We've got a volume profile level that hits at 43.20. And the trend line hits at 43.20, 43.30. And the 200 SMA hits at 43.20, 43.30. Well, it's there. This is it, for the market. The bears are going to do something. You really hope they do it here. Some people have 44.10 as their level due to some other volume profile concepts. It's a big level, but realistically, no, we're ahead of the news. Look at where we are. Look at the extension. 7 gaps left behind on the stock market. It's hard to not be, potentially looking at your scaling concepts and stuff ahead of this news. Now, for anyone that's held in, well done. Obviously, I started to turn pretty damn bearish in this area here, which has always been consistent. And that doesn't mean that we have a bearish trigger. And let's look at that right now, because you need a bearish trigger to pull the trigger on these particular stocks. And how are you going to get one? Well, you need to see turns. We haven't got any turn in the last literally 250 points in terms of there hasn't even been a smidgen of turn. Every single one of these troughs, the 42.50 now, the 42.25, the 4200, really holds probably a bunch of orders. It's just been new peaks, new troughs, new peaks, new troughs, new peaks every single time. So where's an important zone now? Probably the 42.50 from the previous session. If we go down to the smaller time frame, let's go the 5 minute here on the futures. You'll notice that the market kind of came down early, filled the gap, swung the high, allowing some scalpers to get into a quick short here. Didn't complete, didn't even get close to completing. That's why you've got to be very nimble on these types of positions. I did tweet about this one. And then basically it's come back up. Now, if we see the market go back under 42.50, it's our first sign of some bearish action. We still have to clear the big level, 4200, which is the previous resistance on the daily and weekly chart. So if you go to a weekly chart here, you'll notice that's where you've got that kind of high over here, 4200. So that's going to be the big real turnaround story. But on the smaller trades, still nothing. 42.50 must be broken. Let's now take a look at options heading into the Wednesday. This is, of course, the FOMC statement day. Usually the big traders don't trade this. You can tell because the volumes are quite small. Small traders went super bearish over the last 24 hours. They're just buying puts everywhere. It's kind of annoying because the more little small traders that do something, the less likely it is that it will work out for us. And that's why you've got to be adaptive in this market. Look at the small traders. They're getting crazy down there. So they've definitely been buying puts here for the Wednesday. But when we go out to the Friday expiration, look at the max pain level change. 405. Where are we right now? Almost 4,300. So 430. 405 is the Friday reading. That's a big difference. That's a huge difference. And this is the big one. Look at the sizes all of a sudden. 110,000 puts opened. They're all going to lose. Bad luck. So sad. Too bad, so sad, guys down there. And that's probably big traders as well. The hedgers are going to lose some of their big positions. They tend to go on these third weeks. But the buyers are still opening decently here. And of course, depending on what happens with this FOMC, can we suck in enough people towards the bull side? Watch this max pain, see how it changes. At the moment, if max pain's going to work, it'll be this Friday. This is the only one that I really pay the most attention to. And of course, it's so far away from price currently. It doesn't have to work. It's something that does help us kind of understand the market conditions. Let's move over to Bitcoin and crypto. Look, frankly, this is a horror looking chart. It just continuously has rejection weeks. I don't think if you're trading crypto, you're trading Bitcoin right now. It's usually Ethereum. So let's have a look at that. Much better, cleaner chart. Ethereum picked down. So it hit 2000, which was our target the other day. We're moving towards ideally pulling back into like a 1700 to maybe 1750 zone. That's the box area we've got here. And then if buyers are going to come back in, they'll show commitment here, I think, on Ethereum. Don't feel too much FOMO. It's still not even near the cyclical lows of what you usually see in crypto. Of course, it could come back if the stock market really does rally. But at this stage, Bitcoin and Ethereum kind of look weak towards the short side. If you haven't already, follow us at FX Evolution on Twitter. Of course, join us in Discord in the public or private 7-day free trial community. Links in the description down below. And remember, guys, it is Wednesday. Core retail sales, 8:30 a.m. New York time. FOMC meeting minutes, 2 p.m. Will the Fed claim that they've pivoted and dancing around? It's all good. We'll find out. And most people, it seems, are placing the bets towards the bear side at this stage, including the small traders, including the hedge funds. It really has to pull through with more buyers for this market to fall down. It's very rare that the market goes down when everybody is super bearish. It's the opposite, yeah. All right, thanks so much for watching. If you enjoyed today's content, remember to subscribe, smash the like button, guys. It does help us out. We'll see you in the next one. Bye for now.